The following is a presentation of TFNN.
All right. Hello, everybody. This is Don Kaufman from ThinkorSwim by TD Ameritrade for the Options Hour. So, again, this is a call-in show. Be sure to give us a call at 877-927-6648. Again, my name is Don Kaufman. I'm going to take you through the Options Hour today. All right. Take a look at the market. You know, it's going to be an interesting session here today. There's a lot to talk about. I've also probably got about 5 or 6 emails already in regards to questions, things that have come up here over the last week, since last Tuesday, a couple things I talked about. So we're going to read some of the questions to you guys live. But again, feel free to chat in. I've got Tiger Den, of course, open, reading the chat in there, or call us again at 877-927-6648. Again, this is a call-in show. It's the Options Hour. Give us your questions, whatever you guys got. So let's just give you kind of a quick recap of what's going on today. Again, kind of an interesting day. How did it start off? For those of you that were up early this morning and even last night. So futures last night were actually up, and they were up considerably last night. You know, saw the ES futures trade as high as about 5 last night. I woke up this morning. Futures were flat. Of course, sold off into the open this morning. In fact, you know, taking a look, I haven't seen one of these intraday reversals like this in quite a while. It was done on some decent-sized volume. So the guys were watching this morning. NASDAQ futures tanked at the open. Order flow was actually showing pretty good size coming in, selling, and 15 minutes after the open, we just absolutely took off to the upside. So we saw, you know, kind of a classic 15-minute like reversal this morning. And again, I'm not a market technician whatsoever. I'm looking at order flow here, and there were some signs of a possible reversal earlier this morning. And we're going to talk about that a little bit right now before we take this first caller here. So, again, ES futures up 14, NASDAQ futures up 21, Dow futures up about 150. Okay, on top of that, you see the VIX now is down $1.30. Interestingly enough, this morning, so you saw some selling pressure come in early this morning. And the VIX did not really confirm. If you take a look at the high in the VIX today, it was 21.06. I mean, the VIX really didn't take off, again, at all to the upside on some selling pressure that came in this morning. Of course, we've also seen oil down. Now, the thing for me that was also kind of a little bit off this morning is that when we saw selling pressure, we actually saw interest rates up very slightly this morning. They were really kind of meandering, so we didn't have confirmation of the sell-off this morning, you know, hence we see pretty good size reversal. And, yeah, we're strong from here, which I got to tell you from my own position, this is not a good thing for my own position. Yesterday was a fantastic day until, you know, the last 20 minutes of the day when we started taking off again to the upside. Yesterday at one point for the NASDAQ looked really ugly, too. I don't know if you guys are out there rooting as well. You know, on top of that, some news out today about Netflix. Of course, Netflix getting crushed today. I don't know how many of you guys trade any Netflix, but Netflix down almost $11 in the day. I say getting crushed. I mean, come on. You know, $10, $11 in a $200 stock. We're looking at like a 5% move. But Netflix, of course, has been extremely strong. So some individual news out on Netflix. What's the news on Netflix? Facebook is kind of partnering right now with Warner Brothers to possibly release some type of content through Facebook. And when I say content, some type of streaming content that could possibly compete with Netflix. What's unbelievable is Facebook, you know, even so much as looks at you right now, and your underlying is going down, and they're not even a public firm at this point. So Facebook kind of throwing around a little bit of power here today and a little bit of a threat to Netflix. So obviously that's trading down considerably. And somebody in the chat room said, don't remind me. I don't know if that's don't remind me about this or don't remind me about, you know, something else. But, yeah, kind of interesting there. So we're going to go right to it here. We've got a caller in again. I want you guys to give us a call, talk anything options, futures, options on futures, you name it. VIX you want to talk about, give me a call at 877-927-6648. So let's go to our first caller, and I think I have talked to him before. This is Mike in Colorado about Ford. You there, Mike?
Yes, sir. We did talk about this once before. I bought a put spread on January 31st, and it was the March 15-14 put spread.
Correct.
And I'm still in it. I'm going to wait until the end of the day to decide what to do. But if it shows some weakness and it starts turning back down again to where I think it's going, which is about 1273 area based on an ABC pattern, is it my question has to do with closing it out. Is it best to close out a put spread early in the week of options expiration, or you wait until the final day to milk the profit?
All right, so you got to refresh my memory. You long the put spread here?
I bought a put spread, yes.
Okay, and you bought the 15-14 long put spread, so you're a little bit bearish on this trade. You know, what's interesting, when you're long the put spread, it's a little different, obviously, than the sell side, being on the opposite side of the market. When you're long this put spread, you're long the 15-14 put spread, you're in the money right now by 50 cents. So I'm guessing, that you paid somewhere in this neighborhood for it. I just don't remember right off the top of my head what you paid for this particular put spread, but so it's got intrinsic value right now of 50 cents. If you still have that bearish bias, you're basically you got yourself 10 days. Now, the worst that's going to happen to you in this put spread is whatever you're in it for. Let's say you're in it for 50 cents. That's pretty much what you got at risk, and you got about a 50-50 shot right now looking just purely at probability. That being said, if you've got a conviction that we're still going to sell off in the next few days, you got yourself some time. Exiting these things, you're not going to have to worry too much on this put spread about exiting it, before expiration. That being said, you still want to get out of it probably Wednesday, of expiration week, really the latest. So that time frame that I've always talked about is about 4 to 10 days prior to expiration is usually a good time to exit things. In this case, though, you are right kind of on that hinge point, and you're getting pinned a little bit with this stock right at 1450. So the other thing you could always do, which I bring up, is if you're long, for instance, 10 of these put spreads, why don't you chunk out of 3 or 4 of them today, wait a few days, chunk out of another 3 or 4 of them, and look at it as kind of protection of either, number one, your profits in there, or just protection. You don't want to lose another 50 cents.
Okay, I appreciate it. Thank you very much.
Yeah, no problem. So thanks again for calling there, Mike. All right, so that's a pretty straightforward call. Getting in and out of trades, you got to look at all your trades as not as one entire chunk, simply meaning that everything you guys have in your portfolios, a lot of the times you see clients and they have 10 contracts, and they look at this 10 contracts as kind of all or nothing. And that being said, it's not all or nothing. If you've got a 10-lot spread on there, or you got, 20 contracts, or even if you have 5 contracts, you can always stagger out of that particular trade. Now, when I say stagger out, you chunk out of it, one contract, another contract. The problem, comes with this, commissions. And it's something, I don't talk a lot about on the show. We're a brokerage firm. I mean, we're, ThinkorSwim, TD Ameritrade here, and ultimately, our business is a transaction-based business. That being said, you want to make sure that if you trade some decent amount of options, that you go out there, all right, and you try to get yourself a commission structure that does not force you to trade 10 contracts at a time, because it kills clientele in this industry. One of the scariest things is when you have to pay a very large ticket charge plus, $1 per contract, it becomes difficult to break up your trades. I mean, how else are you supposed to go out and price things as well? You're not really sure what a spread is going for until you route that first order. One of the worst things that can happen to you, and I'll click here into into things like the spiders. One of the worst things that can happen to you when you guys are out there, you're trading. If you were to route an order, when I say route an order, you're sending it off an order. If I hit confirm and send, and I'm sending this order right, for instance, at 49 cents, I'm looking at a 133, 134 short call spread, and if I were to send this thing for 49 cents, and I'm like, wow, I got all the conviction in the world, I want to do it 10 times, I hit confirm and send the trade, and it fills instantaneously, you got to stop and think to yourself, damn, I probably did something wrong. And a lot of clients are like, whoa, I don't get it. What do you mean? What do you mean you did something wrong? You got filled, and you got filled at the mid-price. Yeah, but you know what? You possibly could have gotten filled a penny better. I mean, how do you really know? So you go out there, all right, trade small, stay small. It's okay to fire a one-lot trade. When I say one lot, one contract. B, Captain one lot. All right, so trade small, again, stay small. You'll be better off that way, staggering into positions and staggering out of them. Especially for those of you guys, I know that if you're in this chat room right now and you're also listening to this, you're sitting in front of your computer all day long trading. If you have that time, great. Stagger in the trade, stagger out of. Now, some of you guys work for a living and you're listening to this on a podcast, and if you are working and you're listening to this on a podcast, when you send off an order at night, okay, send it off at a very advantageous price to you and let the market move to you. Meaning, don't just go in there and go, wow, I absolutely have to get filled on this particular spread. You got to always remember, okay, in this business, nobody needs trades. You might want this particular spread on, or you might want that futures contract routed, but nobody needs the trade. Let the market come to you. There's no reason to give up a penny or two. You know, again, I talk about this all the time, but giving up a penny on a one contract trade is giving up a buck. A lot of people that trade complain about commissions, but you should actually look more at the bid-offer spreads in here, because the average client in this industry to this day still gives up more in the bid-offer spread than they do pay in commissions. So keep that in mind, because, that's what this business is about. You got to squeeze every penny you possibly can out there. So with that, I don't want to ramble on nonstop over here. Give us a call at 877-927-6648. All right. With that, we're talking a little bit about the marketplace before Mike called a little bit about, Mike from Colorado called about Ford. And ultimately, that's what we want. We want you guys, give us a call. We'll talk about some of your trades on here. And really, I see somebody right now talking about TBT and natural gas prices here in the chat room. So feel free to chat in questions as well, because I'm reading them as we go along. So with that, take a look at the market today. So NASDAQ futures are actually up 21, almost at the highs of the day. Same thing with S&P futures. We're right off the high of the day. Kind of surprising. Saw a pretty good reversal from yesterday. But for those of you that are into technical analysis, I'll pop over to a chart really quick. Ooh, I never do this. It almost pains me to have to pull up a chart. The irony of that is, and I'm not sure I've ever talked about it on the show, is, again, I'm not a big chartist. I'm much more of a tape reader. Of course, I've talked about that on the show. The reality is simply the reason I'm not looking at a lot of charts, and that also includes myself and Tom Sosnoff and a lot of the guys and Joe Kinahan that we work with, at ThinkorSwim, is ultimately, we sit in front of these computer screens nonstop every day for the last, at least me, 12 to 15 years I've been watching these marketplaces. And ultimately, I'm a walking, talking chart. I mean, I know every single point at which the spiders have been, the S&P has been in the last 10 years, and I can pretty much tell you tick for tick. And by the way, that is not a good thing. It is a sickness, all right? Half the guys that I know that I've traded with over the years, you can ask them what their position was on any specific date going back 3 or 4 years. Ask them the color of their wife's eyes. They don't even know who you're talking about. And that's the reality of the trading business, the interesting business. So I'm just going to zoom in over here because I want to make an interesting argument over here in regards to just trading in general right now. So if you guys take a look at this chart, you see some pretty erratic movements on the spiders. And I'll kind of zoom in here to a full screen if you guys are watching. But I say pretty erratic. Back, of course, in February, about 18th and 19th, we finally started to see some selling. What's interesting, taking a look at the chart, is that you're starting to see, volatility coming back in. And it simply means that, so we've had a little bit of a sell-off, followed by a couple of days of rally, another strong sell-off, a little bit of a rally, we sell off again, we rally. So we're getting a lot of two-way action in this marketplace right now. What's, again, two-way action here, is fantastic for those of you that utilize options. And again, those of you that trade on an intraday basis, it's not just a freight train to the upside. And you look for this kind of stuff. You know, the last 2 weeks, this is what you wait for, especially when you sell premium. The problem, though, that we're seeing right now is you look at this chart and you're like, wow, okay, vol is back. All right, so volatility is definitely here. Not sure if it's here to stay. But then you flip back over and you take a look at the VIX and you're like, well, the VIX isn't that exciting, though. Okay, the VIX here has barely, in the last couple of weeks, even cracked 23 for a brief moment, or 22. What you have to start to understand is we may be in a new low VIX and low volatility environment, and this may be the new normal. All right, that's a critical aspect that a lot of people have to kind of understand is, you know, this may be the new norm. After you go through something like 2008 and 2009, you know, you start to lose sight of what volatility really is. So all of a sudden, we're now in a period of complacency. And this may be, again, the new norm for a considerable period of time. I don't know if you guys remember, but you go all the way back to 2003. 2003, where was the VIX? In fact, we can even pull it up. Ooh, it'll be exciting. Let's go back to a 10-year chart over here. Back all the way to 2003, because I remember it extremely well. 2003, 2004, the VIX came crushing down, and you'll see the vast majority here, all right, of 2004, the VIX is down in the 10 handle. It was just sick. It was boring. Nothing ever happened. We didn't really see the VIX starting to pick back up again until about 2007, when we saw just a little bit of vol starting to come back in to the marketplace. Anyway, a little bit of a 10-year chart there on the VIX. Thought that was kind of interesting to talk about. Ultimately, so let's talk about why. So volatility obviously is down today, and volatility just could be the new norm in a lower volatility climate. However, if you guys trade options, volatility is everything. I mean, in the end, vol prices risk. I mean, in the end, literally what volatility is, it's supply and demand, and specifically what the VIX is, it's supply and demand of the S&P 500 index options out there. All right, so let's get some callers in here, and I'll continue on along this lines, but let's get some callers in here because it's kind of quiet today. I mean, come on, Mike from Colorado, we're going to have him call back in a minute here if we don't get any other callers. But give us a call at 877-927-6648. So I see a lot of you guys here in the chat room also talking about Facebook, Netflix. It's interesting, I got to tell you. So I was talking about this a little bit last week. I'm not on Facebook. I'm not getting on Facebook. I don't want to get on Facebook. And there's just too many reasons for that right now, to discuss. But ultimately, I see a lot of time, a lot of people on Facebook here. Anyway, again, I am in the minority there, so I got to be a contrarian on everything. Anyway, people are talking about in the chat room here, so consumers to purchase The Dark Knight for rental on Facebook. The reality is we'll see how this entire thing plays out. I mean, Netflix has really got excellent market share at this point. Is Facebook a threat? Sure, they're not necessarily a public company at this point, so what's going on internally there is, I think actually gives them a little bit of an edge. Being a private firm, they have ability to be fast and furious, where Netflix, of course, now being public, is kind of a slower-moving animal. So with that, let's talk about a few other things over here. I'll come to some email questions that I got just before the show, and I'll read off some of the email questions in here because they're fantastic. But before we get that, we were talking a little bit about volatility in general, and volatility being down considerably. Just this low volatility climate, as I was saying, could be the new normal for the marketplace. And the reality is, and I know I've talked about this in previous weeks, but the reality is that the world is figuring out other ways, in essence, to be able to manage risk other, than going out and demanding puts. Now, you have to remember the VIX, the S&P 500 Volatility Index. It is, a measure of the supply and demand on options within the S&P 500. But the reality is this: if the demand is not as high, when the market sells off and sells off hard, demand rises for put options because puts are utilized as insurance contracts. For the most part, buying those puts provides portfolio managers a hedge against their long positions in the marketplace. Anyway, with that, if you look at the day, where the Dow, for example, if the Dow were up, 200 points in the day, you have to ask yourself, where do you see volatility? So the Dow is up 200 points, for example, you see volatility down. Because a lot of people have this misconception that volatility is movement, but it's not. Okay, again, volatility is much more definitively risk. However, you can extrapolate that risk into how far a stock can move within a given period of time. So with that, give us a call, 877-927-6648. It's going to be a lonely session without you guys calling in. And really, you can call about any option position, futures, options on futures. I'll tell you what, why don't you just call and tell us where you think the market is going here, short-term, long-term, so we get some good argumentative callers in. It's always a fun thing. Anyway, with that, talking a little bit about the VIX again. So what other instruments can be utilized to be able to manage risk? Well, as we start to move into more efficient marketplaces, which we're in right now. We're in an extremely efficient marketplace. By that, we have tight spreads. We have a lot of different products. What we're seeing is a lot of portfolio managers, rather than buying, for instance, S&P 500 puts, they'll go out there and they'll sell futures to use as a hedge. Or, so you could sell futures to get yourself short a couple of futures against a long biased portfolio. Or what they're really doing right now is also they're going out there and they're utilizing treasuries in order to be able to manage risk. So a flight to quality, a flight to treasuries, buying treasuries in periods, of a down move in the marketplace, but they're literally subsidizing the utilization of puts by utilizing other instruments, and this may be causing, a little bit of a lower implied volatility environment. So with that, again, give us a call, 877-927-6648, to discuss really anything options and market related. We've got a caller on the line right now. It's Mark from L.A., covered return. So you there, Mark?
Yes, Don. How you doing?
Good. How's it going?
Pretty good. I got a question, especially on the TOS platform, the covered return column for covered for single. When you look at the single option, it'll have a covered return.
Absolutely.
But my question is, how come it's 100% when if you were to buy that covered call at that strike, your return on equity is only maybe 5%, 4%? Where does it get really 90%?
All we really do on the covered call return is simply this. We take the premium, of the call that you're planning on selling, and basically we just divide that premium into the underlying stock price, and that basically gives you the covered return. So ultimately, if it's like $100 stock and you collect, $1 out there, it'll just give you that particular covered return there. That's it for the most part. And of course, we break that down on a monthly basis, a weekly basis, any one of those covered returns there. So it's a pretty simple calculation on the covered return. Honestly, the one that I find that's the most confusing on there, and I don't know if you've utilized this before, but we'll actually look at return on risk and return on capital. And those become a little bit more convoluted because return on capital, for example, takes in what type of margin you have in your account, and return on risk looks a little bit more purely. Return on risk is how much risk you're actually taking versus the return. So any one of those can be utilized, though, in essence, the same thing as the covered call. So I'm taking it that you do a couple of covered calls there, Mark?
I have, and look for something. Return on equity is what I figure, you buy a
right. You know what? They're just varieties, different variations of the exact same thing. I mean, one thing that I always talk about, like in the covered call, I know a lot of people look at like covered return and so forth, but ideally, one of the best things that you can look at is what delta are you selling, in the covered call. So, in most equities, you just basically go one strike out of the money. If you're selling a covered call, though, in a fairly liquid underlying, got a lot of strike prices, something like the spiders, even if you wanted to do a covered call in there, try to look to like a 30 to 40 delta option, because that inversely gives you about a 60 to 70% probability the option you're selling expires worthless. And,
that's if you want to keep the stock, though, right? I don't care if I get exercise.
Yeah, absolutely. You know, one other thing to think about. So, do you already own the stock, or are you buying the stock and just selling like the at-the-money call?
I do as a package.
All right. So,
whatever they covered stock, I think they call it on ThinkorSwim.
Absolutely.
Yeah, I just look for high volatility, and I look for something I like that's not going to dive bomb maybe.
Well, that's the whole key. That's the whole key. One thing, I'll just give you my interpretation of it. You know, you can also, rather than going out and buying the stock and selling the call, a synthetic for selling the covered call. When I say synthetic, another way to basically do a covered call is to just sell a naked put. I mean, it's basically the exact same trade.
Is that allowed in an IRA account?
Yeah, you can. As long as at ThinkorSwim it has to be cash secured, which you have to be cash secured to basically buy the stock anyway. I'm just trying to save you a little bit in transaction cost there. You know, so selling the naked put is pretty much the exact same thing as the covered call. And that's always, you know, an interesting thing, because most brokerage firms, if you call them and say, I want to do a covered call in my IRA, they love you, right?
Right.
Call up a lot of brokerage firms and ask them about selling naked puts in an IRA, and they basically go, oh, scary thing. But the irony is it's the exact same trade. At ThinkorSwim, you can now trade anything you want. So you can do spreads in an IRA, you can sell naked puts. The only thing you can't do inside of an IRA,
you can't margin and you can't sell a naked call.
Right, you can't sell a naked call, and you can't short, all right, stock. But they've got all these inverse ETFs out there. The other thing is, in a true ThinkorSwim account, you can even trade futures now if you qualify. And there is qualification, but you can literally trade futures now inside the IRA. So that's going to be the end of a lot of people now that they just heard that. And that's something we don't really talk about all that often. But yeah, you can do pretty much anything you want in your retirement account now. It's great.
I think so. I think there's slightly cheaper brokerages, but you guys got a lot of value-added stuff in there that saves you a lot of time looking around. And I think
call us, negotiate with us. You know, I shouldn't say that in the air, but you know what? The bottom line is when it comes to transaction costs, and we're so open about this, we're not going to lose your business based on transaction costs. I mean, basically, if we can make money and it works for us, you know, open up an account and we'll get it done. Is what
I'm not J.P. Morgan though. I'm it's maybe a trade a week or something, a couple trades a week.
No, that's fine. That's fine. You know, and that's you know, the reality of the business is we really try to provide you everything you're going to need for the business. When I say everything, I mean everything from charts, you know, every quote, so that you really got to minimize your cost of being in this business in general. And that was kind of our notion when we first started up ThinkorSwim, was basically, listen, we got to pay for the data anyway. We might as well build all the technology behind it. And we've been doing that ever since. I mean, all kinds of cool features, though, in the last couple of releases that have come out.
Listen, you got a call waiting? I got one more quick question.
Yeah, go for it.
I'm looking at the current price, waiting for something to fill right now, and I notice sometimes it goes out to 4 digits.
Yeah.
79.1559 or something.
What underlying you're looking at?
Can you put I'm going to buy a couple HGSIs, the human genome, sell a couple call on it.
All right, so you're looking at the stock, and sometimes the stock goes out to 4 decimal points?
Right. Can you put an order in like that, too, for 4? Is there an advantage to do that or not?
No, but what you'll do is basically when you put an order in, like right now I'm looking at the spiders, and it doesn't matter which underlying, but the spiders basically you're trading at 132.79.
Right.
If you routed an order right now at 132.79, it would probably fill you 1/1000 of a penny better. And ultimately what's happening right now is there are so many derivative firms, all right, and basically what that means, there's so many market-making firms that are fighting for order flow that they're literally willing to give you 1/1000 of a penny better, in essence, to be able to grab your liquidity. And that's critical, all right, that you can receive thousandths of a penny fills through a firm like ThinkorSwim, TD Ameritrade. But again, you're not going to be able to enter them that way. But in essence, all right, you don't want to be able to enter 1/1000 of a penny out there, because then if they don't hit you on that limit, it's got to be that or better. So we really keep you to, of course, to 2 decimal places there on your stock order flow. You know, but yeah, it's an amazing market now when we're filling in thousandths of a penny. You know, when I was talking about this with Tom O'Brien yesterday, 12 years ago, we were making markets on options that were $3 wide, and now we're talking about thousandths of a penny and getting filled on that. This is, just a utopian way to be able to trade. It just doesn't get any better or any tighter of a market.
There's no vigorish there, is there?
Oh, man. It's, in their right mind, who wants to be a market maker in this business? I mean, the market-making industry now is nothing more than a bunch of servers, Sun servers, that are just basically trying to capture fractions of a penny and do it tens of millions of times in a day. I mean, that's the entire market-making business. These guys aren't necessarily out there, trading per se. They're just out there in automation, okay, and just, filling as many orders as humanly possible. Yeah.
Anyway, okay. Thank you.
Different world. Yeah. Thanks for giving us a call there, Mark.
All right. Bye-bye.
Bye. All right. So, again, I'm just looking here at some of the chats going on. But, again, some interesting calls here this morning. But, again, give us a call, 877-927-6648. If you've got anything, stock, options, futures, options on futures related, you just want to talk about the general marketplace. Again, this is the Options Show. And the Options Hour, we want your option-related questions. I'm always surprised whenever I do this. We get a lot of clients call it, they talk about covered calls, which is fantastic. That is, a marquee trade, obviously, in this industry. But, I don't have a lot of people call up about iron condors, not a lot of, spread traders out there. And the more convoluted the option trade gets, the more fun it is for me. So give us a call when you guys have got your questions out there. We are here to answer them. So with that, I want to actually read a couple of emails because I had some questions directed to me, and I promised these guys that I would actually kind of read them off, while we were doing the show. And, let's jump into it here. So, a couple things I wanted to talk about up front. Got basically a client. His name is Michael, and he's got a trade on USO. So, Michael, your trade on USO, bottom line is what he's got on USO is he's got a March call. So he just went out and bought a March call. He bought the March 36 call. It looks like more than a couple of weeks ago. And obviously, all right, a March 36 call, he's long, bought it about a month ago when it was still slightly out of the money. So the first thing I want to talk about is buying an option that's out of the money. And I'm going to go over here to what's called probability of expiring. Now, probability of expiring is probability of an option being in the money by 1 penny or more come expiration. And I really think it's important to talk about this because whenever I talk about options or I teach options, I'm not the biggest proponent of buying out of the money options. And ultimately, it's because your long-term probability of success in these trades is extremely low. That being said, can you buy options and make money? Yeah, you better believe you can buy options and make money, all right? I mean, you could buy, like a 36 call in March and have this underlying run to 42, and that's USO. Now, ultimately, though, if we were to look, for instance, to the April options in USO, and I were to buy a slightly out-of-the-money option, like a 45 call, there's only a 30% chance that this 45 call is going to be in the money by 1 penny or more come, all right, the April expiration. And ultimately, that's all the probability of expiring does. So please do not confuse probability of expiring and say, hey, this is the probability of me making money. No, you don't make money, okay, if we are at 45. You need to sit 45 plus the $1.28 that this option is now trading for. So ultimately, you need us where? Okay, you're going to need us even above 46. Now there's only a 25% chance of getting there. Okay, so that is ultimately why buying these options has a relatively low probability of success. Now, that being said, all right, Michael went out there and he bought this 36 call. It is now deep in the money. And the question that he actually had was, so what do I do? If I want to own the stock, okay, if you want to own the stock, and we got another caller here, so we'll take that one in just a moment. But if you wanted to own this stock, you could, all right, allow this particular trade to run right to expiration, and the option clearing corp will automatically make you long that stock. So the exercise assignment rules, bam, you own the stock. Now, his question was, do I exercise my option and buy the stock before the expiration date? And the answer is, I don't. all right, I'm not going to go out and like literally buy the stock at effectively $36 right now, even though it's trading at 42. Even if I want to get long the stock, I'm not going to do it. And the reason I'm not going to do it is, first of all, there's no time value left in this particular option. If you go out and you exercise your right to buy this stock at 36, now you got to put up capital. And capital, all right, on a $36 stock for 1,000 shares, just say without Reg T margin, without margin in there, you're tying up $36,000 on 10 contracts. There is a cost of carry of that stock. So ultimately, it's effectively right now being long, all right, this in-the-money option. The delta of this in-the-money option is 1. So you're effectively long stock, okay, for next to nothing right now in terms of cost of carry. If you want to own this stock, yeah, let it run to expiration. Otherwise, if you're happy with the profits, blow out of it. Don't exercise it and then turn around and sell the stock. Just sell the option, all right? So keep that in mind for all of you trading out there. In all the years of my trading, I have only exercised an option a handful of times. And one of them was basically like on a dare. They're like, I dare you to exercise this particular option. You know, not real big about exercise or assignment out there. So with that, let's take another caller. We'll come back to a couple of questions here in just a moment. Another caller, Jim in Seattle. Options and buying. Jim, you still there?
Yes, I am, Don. Thank you. Don, I had spoken to you about this thing a couple months ago, and I guess I still don't understand it because I experienced the same problem again. Basically, I had a vertical that had a few days left on it, and I decided just cover it and get out. And I put my order in, and I'm looking at it, and the market is trading. Let's say it was a 52 cents credit or debit, right?
Okay.
And the market's trading through it. And you told me about the actual trade price and the theoretical price, but with a couple of days left, I'm thinking the trade price, the actual price, and the theoretical price have to be pretty close to each other.
Actually, there's an easy explanation for exactly what's happening to you. One other question I just got for you in regards to this trade: how many days before expiration are you trying to get out?
In this particular one, it was there were 2 days left. Okay.
So the first rule of thumb is simply this, and bear with me because I'm going to explain exactly why this is happening to you. But on basically Wednesday afternoon, Thursday and Friday of expiration week, it is going to be dramatically more difficult to exit spreads, especially at theoretical. And I'll get to exactly why you're not filling here. But it is going to be dramatically more difficult to fill spreads and single option trades coming into the expiration cycle. And ultimately, what that has to deal with is that market makers realize that coming into expiration, if you are trading and you are a retail client, and they know that you're a retail client because your order is tagged with an R, they know one thing: whatever it is, you're trying to get out. So the markets become that much more difficult. And I don't want to say that the market makers are kind of putting the screws to you, but what they have is they're switching up, okay, how the orders are filled. They're actually changing the algorithms, which is an equation of at what price you get filled at. So you come into like Friday afternoon, and yeah, they're kind of screwing you a little bit in there. Now, that's, of course, during expiration. Now, your trade has another interesting thing, and I'm just going to pull up a spread right now. I'm pulling up, for instance, a March 134, 135 spread, and it's showing a mid-price credit right now of 36 cents. But herein lies a problem, okay? For example, the spiders are now quoted on 9 different exchanges. Mm-hmm. That is, the bid and offer is quoted on 9 different exchanges. The problem is the spread itself, okay? The price that we're using on ThinkorSwim is showing you a credit and a mid-price, okay? And right. It's diverging off 2 separate exchanges, meaning the bid on the 134s, okay, could be crossing another offer on another exchange for the 135s. So the mid-price that you're seeing is really derived from all 9 exchanges, okay? The honest-to-God truth, though, is that your spread is only by rules allowed to reside on one exchange where the price is actually being derived from all 9 exchanges. And it's a frustration that it's still good that we're putting the mid-price on the platform, but it happens from time to time that you're like, damn, it actually traded through my price, and I'm still not getting executed on it. But that's what it comes down to.
Yeah, and, like I said, I've seen it on several occasions, and not by 1 cent, not by 2 cents, but as much as 4 cents.
Yeah, can I ask you, what underlying you trading?
It was this particular one, I believe, was a TZA, or it might have been the SDS. I forget. I had all three of them: the TZA, the TWM, and SDS, and I don't remember which one of those. And it was
one of those,
this particular one. I believe I had 5 contracts left.
Each one of those that you have mentioned have particularly wide markets on the bid-offer spread. And that's really another effect that you're seeing, especially double inverses. And I remember we talked a while back in regards to
yes.
But these have particularly wide markets, and these are underlyings that, man, it is tough to get filled on an option trade, especially when you're coming closer to expiration. Now, SDS has got pretty good liquidity, and the open interest is high, the volume is high.
Yeah, right.
TZA hurts, man. That hurts. They're going to rip you pretty hard because the volume is so low on TZA. So it obviously depends on the underlying. And if you mention like underlyings, like I literally will sit here and trade one lots just to try to feel out where the marketplace is, and you can immediately pick up like, is this liquid? Is it not liquid? You just got to be a little bit more advantageous in the products that you trade. Be careful though in some of the double inverses and the triple inverses. Because they're brutal trying to exit some of these trades. And it's again,
right, and I remember the admonition you made, comparing liquidity on those to the ES, that it might be even better to just go over to the E-mini.
Oh, 100%. You know what's
because you basically got that 1 penny spread.
Yeah, so I'll tell you something really interesting about the double and triple inverse ETFs. Their volume on the shares is extremely high, but the volume on the options is low. And this is simply the reason why. The TZA, the SDS, are part of an arbitrage program. That basically means they're arbing it against the spiders. They're arbing against the underlying, the primary underlying, or they're arbing it against the futures product. So it's basically showing a hell of a lot of shares trading, like in TZA, they've already done 13 million today, which ain't half bad. SDS has done a lot. But the reality is, what's not arbing, with the arbitrage relationship, doesn't necessarily exist in the options concept.
On the options. Okay, that clears that up, yeah.
Yeah.
Because I had seen, I don't know if you remember that trade that happened on one of those, slimmed down stocks, I forget which one, Weight Watchers, I believe it was Weight Watchers. This guy was able to buy, tens of thousands of contracts in the last day before the earnings came out. And here I'm struggling with 5 contracts trying to get that executed.
It's interesting. Like if you really have a tough time getting internet or some of these, give us a call sometime. Call up the ThinkorSwim trade desk and say, hey, I think I'm getting screwed over here. And they'll literally get on the phone and be like, you are getting screwed because the markets are wide, and we'll give you really a clear indication of how and why with some of these particular underlyings. Because we literally, between myself and all the guys at ThinkorSwim and on the trade desk, we trade all these products here.
Sure.
We're familiar with them. And, we'll tell you whether they're fair markets or not. Okay. And the other thing is, in just the last 6 months, since this rally really ensued, liquidity is actually down considerably. Volume is down considerably, not only in options, but the volume, and it's more, I wouldn't say it's the volume on the retail side of the world. Volume in the retail side of the world, at least at TD Ameritrade, is up. We're actually seeing really strong numbers of clients trading. The professional world, though, because they're not making any edge, they're not trading as heavily at this point, so we're not seeing huge volumes out there, and you're seeing some of the ancillary products, like this TZA, like the SDS, some of the liquidity is down on those options over there. So, yeah, definitely keep an eye on that.
Okay, I'll do that, and I appreciate it, Don.
Yeah.
Okay, thank you very much.
Yeah, good hearing from you again.
Bye-bye.
Oh, thanks. All right, so, Jim from Seattle, literally fighting the exact same thing all of us are. I mean, you know what? A lot of you guys, you might call in, you might look for, market insight, but ultimately, getting filled at good prices makes or breaks you in this business. I've always said this, like if you don't get a good fill, I mean, theoretically over time, that really weighs against you in the entire industry. So, you know, be advantageous there, work your orders and work them hard. So with that, I'm just taking a look and reading a few things on here. Let's get some more callers in here. Any more callers? 877-927-6648. This is a call-in show. With that, you know, one other thing I wanted to talk about. So we talked a little bit about USO and be along a deep in the money call. So a deep in the money call basically mimics stock. Anytime you get a call that's in the money and has a delta over about 90. So delta roughly is the rate of change of the option for every dollar move in the underlying stock. Once you get a delta above 90, that just basically means that that particular option is moving 90 cents for every dollar move in the underlying. You're almost getting a 1-to-1 ratio, all right? But owning an in-the-money option is a cheap way, okay, to get long stock, which brings up something interesting. When you look at like a weekly option, if you wanted to just get long, for example, the spiders right now, and you're not interested in trading futures, let's say, but if you wanted to get long the spiders and want a dirt cheap way to do it for a short-term trade, you can immediately go over to a weekly option. And the weekly options on the spiders right now, okay, they're basically the March weeklies. They've got 3 days left till expiration. You see a market here of the 128 calls. The market is, 485, 491. It's a decent way to be able to get long, okay, spiders. Or if you wanted to get short spiders, you could buy an in-the-money put here that, again, has a delta over or approximately 90. Ultimately, one of the nice things is you go out right now, you buy the spiders, or you go out right now and you just start buying futures. If the market crashes, you're going to get crushed. Ultimately, when you go out and buy this weekly option, if it's a short-term trade here, a directional trade, you're buying the 128s, your losses are limited to the cost of that option. And again, you have to understand, I am not a proponent of buying option premium, but this isn't about buying premium. This is about taking a short-term directional trade and a more effective way to do it utilizing, the option weekly product. So always kind of keep that stuff in mind is there are better ways, to do trades like this rather than going out necessarily and trading a future. And again, I'm a huge advocate of futures. I'm a huge advocate of the spiders and S&P. These weekly options have opened up another door to individuals that want to trade, either on an intraday basis or shorter-term basis, You go out there, buy a 90 or 95 delta option there. You've got yourself a nice scalp for a short time, limited losses on there. And the markets, the bid-offer spreads, listen, they're not spectacular, but you see a market right now of 485, 491 on this option. Because the market is 6 cents wide, doesn't mean you got to give up 3 cents on either side of that. All right? Come in here and push the market maker as much as you possibly can. Let the market come to you. There's no reason to go out there, and just force a particular trade upon the world. In fact, if you take a look at this market right now, we can have a little bit of fun here. And you take a look at this market, and I'm actually looking at a version of a NASDAQ level 2 quote, but it's on options. So you see the market here is 484 at 491. I'm going to go out right now, and I'm going to try to buy one of the 128 call for 486, hit confirm and send off that particular trade. And you can literally see my order, my account number on your screen right now if you guys are watching the screenshot and where it resides in regards to the rest of the marketplace. What you'll notice is when I tried, to buy this option for 486, the entire market moved to 486 at 491. Why? Because it's a best bid, best offer market. And right now, I am, the best bid. Watch when I cancel this order, you're actually going to see the marketplace change out over time here, and you'll see we'll drop back to 485. So we'll do it again here, and this time we're going to route this thing, route one contract at 487, try to buy this thing at 487, and you'll actually see I am now on the NYSE at 487. And this is the kind of stuff that you just don't get, the clarity that you don't get on a lot of trading applications. You can see my one lot, and we're now filled. All right, now I'm going to go out there and create an opposite order. So let's try to sell this thing. What do you want to sell it for? Well, we bought it for 487. Let's try to sell it for 487. So now we'll sell it for 487, immediately filled. That is what I'm talking about, trying to go out there and route things at mid-prices. All right, I'm better than mid-price on here. So always, always keep this stuff in mind when you guys are trading, because because this is the side of the market, again, that a lot of people don't understand is, people go out there every single day and they give up huge edge in the industry. I'll buy them for $4.90 and sell them for $4.85 and give up 5 cents. I just traded on here, $4.87 at $4.87, okay? Not half bad to do that. So, yeah, I hope you guys, everybody's like, oh, great stuff. It's interesting. It's basically, I just got long the, spiders for a short term for $4.87 of maximum risk. And with, a moment's notice, got into that trade and got out of that trade. And I got to tell you, we just charged those commissions to Mr. Tom Sosnoff. The greatest thing about trading is trading in Tom's account. Okay, can't get any better than that. So with that, you know what, you guys, I'm telling you, you should trade somebody else's account. It's very easy, especially when it's Tom's money. He has a lot more money, okay, than all of us. Makes it much easier to trade. So with that, kind of a little bit of a market wrap-up here on this show. And again, I'll be back again next week. You got to give us a call. Of course, poor Tom, I'm probably making Tom money out there. Got to give us a call next week as well. Think of all your questions. Futures up 14.50, NASDAQ futures up 20. And ultimately, we haven't moved since we started talking. This has been a fantastic show. Some really great callers here today. VIX down to basically $1.23. Oil pretty much almost unchanged today, down 58 cents, kind of rallying back up from the lows of the day over here. So oil's actually showing some life, possibly turning around, could be up by the end of the day. We'll have to take a look at that. Bonds, interest rates are up very slightly, and of course, keep an eye on all your major products out there. When I say major products, take a look at Google. Netflix still down almost $12 in the day. Order flow is actually selling off a little bit harder there in Netflix. And keep an eye, of course, always on that volatility. With that, kind of wrapping things up here on behalf of TD Ameritrade, ThinkorSwim, the entire group over in our Chicago offices, thank you guys very much for joining us for the Options Hour. My name is Don Kaufman, and I will be back next week, same time. Give us a call. Thank you guys very much, and have a great trading day. Bye-bye.